Chapter 4, Part 3, we're first going to look at the cash flow statement using the indirect method, which is the method favored by most accountants. Now, the statement of cash flow, there are two ways you can do it for operating activities only. It's the only area that's different. You can use the direct method, or you can use the indirect method. The only difference between the direct and indirect method is how cash flow from operations is determined. You always get the same answer regardless of which method you use. Then we have investing. So operating activities are primarily from operations and current assets and current liabilities, adjustments in those. Investing activity is buying and selling long-term assets. And financing is when we borrow money, issue stock, pay dividends. Now again, we have our two formats, the direct and the indirect. The direct method reports the cash effects of each operating activity. The indirect method starts with accrual-based net income and converts it to a cash basis. Now what we're going to do is we're going to look at an example, and we're going to start with an adjusted balance sheet, because that's the only one we would be able to use. Now, what we're going to do is first, whenever you see allowance and allowance for doubtfuls, a lot of times those will just be combined and they'll be called net accounts receivable. Now what you also need, that's why this statement is always prepared last, what you also need is the income statement and some additional information. You would need to know if there were any gains or losses. You'd need those isolated. You'd need to know the depreciation expense that's included in there. And what you would also need is any additional items that are not clear, i.e. were any dividends declared, common stock, was it used just to get cash or was it used for non-cash items? And you would like to know if there were any write-off of collectibles during the year. So this additional information you would need in order to do that cash flow statement. Now we're going to go back to our balance sheet. So in this example, again, we would net those accounts receivable, and what we're trying to explain is this $19,000. So when we add up all of our changes from operations, investing, and financing activities in this example, they should equal $19,000. Now, what we've also done here is we've identified all the changes. So as you can see, we have some accounts went up and some accounts went down, and what we have to explain is all of those changes. So you have to explain all of the changes of the balance sheet, balances on the balance sheet. Now, first, what you want to do is, after you've figured out if they went up or down, the next thing you need to do is you need to go through and identify items versus operating, investing, and financing activities. So and if you notice, I don't include the cash account because that's what we're trying to explain. So accounts receivable, all current assets and liabilities are associated with operating activities. So that would include our accounts receivable, our inventory, our allowance for doubtful, our accumulated depreciation equipment, accumulated depreciation building, accounts payable, and income taxes payable. Now we'd go through and look to see which of these are investing activities. Of course, we'd use investments, equipment, finance, and then we'd go and look at financing activity. Now, if you notice, I ignored land, and that's because we already know that $15,000 of the common stock was actually used in exchange for that $15,000 in land. So now we're going to do financing activity, which would be our long-term notes, our common stock, And again, the land is a non-cash transaction. And the last thing we would, again, it's non-cash because 15,000 was used of the common stock, and we have to remember also to reduce 15,000 from that common stock when we consider how much cash we generated from financing activities. Then we looked at retained earnings. Now, retained earnings is always a combination. It includes net income less any dividends, which would be part of financing activity. Now what we're going to do is we're going to do T accounts and figure out how much cash was involved. And the first thing we need to do is figure out, because we're doing the indirect method, we need to know how much we had in actual depreciation expense that has to be added back in because it's a non-cash item. So we start with our beginning and ending balances that are shown. We know in the problem, the notes that include with the income statement, that we sold a piece of equipment for $10,000 and that it had been depreciated 60%. So we know that depreciation expense would have been $6,000. So we would insert these numbers and take 14,000 minus 6 minus 21, and we get 13,000. Now for the building, nothing else happened, so we know the change there would be 9,000 in depreciation expense. So depreciation expense is going to be 13,000 plus 9,000, or 22,000 is what we have in non-cash depreciation expense that has to be added back in for the indirect method. So now we start with net income. We're going to add back in depreciation expense, non-cash item. We're going to take out the gain because it's a non-cash item, and we're going to add back in the loss because the actual cash associated with the investment in equipment would be shown as part of investing activities. The next thing we're going to do is look at the changes in our current assets and liabilities. Remember, changes in current assets have an inverse relationship to cash. Increase in accounts receivable decreases cash, because what that means is we made sales that are recorded as part of net income, but we didn't get paid for them because our accounts receivable went up. Now, changes in current liabilities go in the same direction. So if accounts payable goes up, it increases cash, which means we bought something but we didn't pay for it. So this is what we're going to do. We're going to show our net accounts receivable adjustment. We're going to show our increase in inventory. Again, if they go up, and if they're a current asset, they have inverse relationship. Accounts payable, it increased, so we added in. Our income tax increase, we add it back in. We add all those up. We have to adjust our net income by reducing it by 19,000 to convert it to net cash flow from operating activities. This total is the same whether you use the direct or indirect method. Now we're going to go back to our comparative balance sheet and see what's happening with our next section. So now what we have taken care of this one, and we're just going to, I like to subtract things out because I know I've already accounted for them. And now what I'm going to look at is investing activities. I have two items. I have investments and I have equipment. Investments went down, equipment went up. I've got to take the additional information, plus what I have to do is look at the T accounts. So for my investment account, I had a beginning balance of 85. I sold investments of 35, and I had an ending balance of 55. So 85 minus 35 minus 55 tells me 5,000 was used for investments. Now cash generated from investments. We have to recreate our journal. We don't know what the cash is, but we know that we had a gain of $15,000, and we know the investment was taken out at $35,000, and now we know that the cash generated from investment has to be $50,000. And you add them together and you get $50,000. Now we're going to look at equipment. So now we have $5,000 that we used on investments, and we generated $50,000 by selling off investments. Equipment. We sold $10,000. So cash used, $48,000 minus 10 minus 70 would be we used $32,000. Now what we have to do is look at how much cash was generated when we sold that $10,000 piece of equipment. Well, we know the loss was 3. We know the accumulated depreciation was 6, and we know the equipment was 10, which means that we had to use cash of $1,000. Now we can do our cash flow from investing activities. Oh, I'm sorry. We received $1,000 on our equipment. We bought equipment, $32,000, and we sold equipment and we got $1,000 in cash. So now here is our cash flow from investing activities. We have our 2 purchases and our 2 sales. Gives us a net change cash flow from investing activities of $14,000. Now we're going to go back to our comparative balance sheets. And we're going to look at financing activity, remembering that we only have $35,000 from the common stock. So what do we have? We have to cross these out. And so what do we have left? We have our long-term note, we have our common stock less the 15, and we have to figure out if dividends were paid. So, to determine dividends, we know that we started with 95, ended with 92. Tells us in the problem we had $67,000 in net income. We do our calculation, which says we paid out $70 in dividends. Cash flow financing activity. We paid off a note, we paid out cash dividends, and we had common stock of $35,000, so we used $43,000 for financing activities. Now we can put together our cash flow statement. And here it is. Now our total change is 19, which is what it should be. We add our beginning balance, and that tells us our ending balance was $70,000, which it was. That ends this presentation on the indirect method.